What we're about to show you is not a normal housing correction. It is the largest institutional wealth destruction in American real estate history, and almost nobody is talking about it. While the media focuses on individual homeowners losing equity, missing payments, or feeling the pressure of higher mortgage rates, a much bigger story is unfolding quietly behind the scenes. Wall Street made a massive bet on housing, a $2 trillion bet, and that bet is starting to fall apart right now. This wasn't a small experiment or a niche strategy. During the pandemic, some of the largest financial institutions in the world flooded into the U.S. housing market, not to flip houses, not to help renters, but to turn single-family homes into a financial asset class. Entire neighborhoods were treated like stocks. Homes were bought in bulk, often sight unseen, often 20 to 30% above asking price. And according to new data from Zillow, that entire strategy is now unraveling. More than half of U.S. homes are losing value year over year. That alone is concerning. But when you look at who owns the homes losing the most value, the picture becomes far more disturbing, because the biggest losses are not hitting families first. They're hitting institutions. The same institutions that told investors this was a safe, long-term, low-risk play. What's happening now is not a repeat of 2008. It's something structurally different. This time, the leverage isn't hidden in subprime borrowers. It's sitting on Wall Street balance sheets, inside pension funds, retirement accounts, and institutional portfolios that assumed housing prices could only go up. And this is just the beginning. According to Zillow's latest national housing report, 53% of U.S. homes are now losing value year over year. That is the highest percentage since April of 2012. On the surface, that might sound like a normal market cooldown. But when you look closer at the data, a much more dangerous pattern appears. The homes seeing the sharpest declines are not randomly distributed. They are heavily concentrated in areas where institutional investors were the most aggressive buyers during 2021 and 2022. Florida, Texas, Arizona, North Carolina, Georgia. These weren't accidental hotspots. They were targeted. Wall Street funds identified these markets as high growth, high migration regions, and poured billions into single-family homes at the absolute peak of the market. During that frenzy, institutional investors purchased more than 300,000 homes nationwide, not gradually, all at once, often competing against one another, driving prices higher with every bid. According to CoreLogic data, the average price paid by institutional buyers during that peak period was approximately $420,000 per home. Today, based on current Zillow estimates, those same properties are worth closer to $365,000. That's a $55,000 loss per property before considering taxes, insurance, maintenance, or financing costs. Multiply that loss across 300,000 homes. That's $16.5 billion in immediate equity destruction. And that number is still climbing. These losses didn't happen because of poor management or isolated mistakes. They happened because Wall Street bought into a single assumption, that housing prices could not fall nationwide. Zillow's data is now proving that assumption wrong. And this is where the real risk begins. Now here's the part most people completely misunderstand. These institutional investors did not simply buy homes with cash and sit back patiently. They used leverage, a lot of leverage. Many funds borrowed between 70 and 80% of the value of the properties they purchased. They didn't just use traditional mortgages. They borrowed against existing portfolios, issued bonds, and structured complex credit facilities designed for one assumption only, that home prices would keep rising. When prices go up, leverage magnifies profits. But when prices fall, leverage does something much more dangerous. It compresses margins instantly. A 15% decline in home values does not mean a 15% loss for a leveraged investor. It can wipe out 30, 40, even 50% of their actual equity. This is what Wall Street calls a margin compression event. In plain English, the math stops working. And when the math stops working, banks start calling. Loan-to-value covenants get breached. Credit lines get reduced. Collateral requirements get raised. Suddenly, funds that looked stable on paper are forced to make decisions they never planned for. They can't simply wait for a recovery. They have debt payments due every quarter. They have investors demanding performance. And they have lenders watching their balance sheets very closely. This is why small declines in housing prices can trigger outsized consequences. Not because the homes themselves are broken, but because the financial structure built on top of them is. And that structure is now under stress. Now here's where this story stops being abstract and starts becoming personal. Because the money that flooded into housing did not come only from hedge funds or private equity firms. A significant portion of it came from pension funds, public retirement systems, teacher funds, state employee funds, the kind of money that millions of Americans depend on for their future. According to SEC filings, some of the largest pension funds in the country allocated billions of dollars to residential real estate strategies during the pandemic years. They did this at the exact moment home prices were peaking, not because housing was cheap, but because they were chasing yield in a world where bonds paid almost nothing. Funds like CalPERS, the Texas Teacher Retirement System, and Florida's State Board of Administration all increased exposure to single-family rental portfolios. This was sold as a safe, stable strategy. Homes always go up. Rent always comes in. Risk is low. Except the risk wasn't low. It was hidden. And now, for the first time since 2009, many of these pension disclosures are reporting negative returns from their real estate allocations. Losses that don't just stay on paper. They reduce future payouts. They increase funding gaps. And they quietly shift risk onto retirees who never agreed to take it. Most people don't realize this until it's already too late. Because pension losses don't make headlines. They show up years later as reduced benefits, higher contributions, or delayed retirements. And this housing unwind is just getting started.
Now let's get very specific about where this is breaking first. Because the housing decline is not happening evenly. It is concentrated exactly where institutional investors piled in the hardest. Florida, Texas, Arizona, Georgia, North Carolina. These were the pandemic darlings. Fast population growth, cheap financing, strong rent assumptions, and massive institutional buying. According to Zillow, these same regions are now leading the country in year-over-year price declines. Take Florida. Condo values are down nearly 10% year-over-year. Single-family homes, where institutions focused most heavily, are down almost 5%. That doesn't sound catastrophic until you realize institutional investors own tens of thousands of homes in Florida alone. In Tampa Bay, funds bought thousands of homes at peak prices in 2021 and 2022. Those same homes are now worth tens of thousands less per unit. Hundreds of millions in equity gone in a single metro area. Miami-Dade tells a similar story. So does Phoenix. So does Austin. And Austin is one of the worst. Institutional buyers paid premium prices to compete with tech money, remote workers, and FOMO-driven demand. Now those prices are resetting fast. And here's the key point. These aren't weak markets collapsing. These were the strongest markets. Which tells you something important. This isn't a local problem. It's a structural unwind of institutional excess.
Now here's the part most people completely miss. Institutional investors cannot simply wait this out. They are not homeowners. They are not emotional buyers. They are financial structures bound by rules, debt covenants, risk models, quarterly reporting. When home values fall far enough, they don't get a choice. They are forced to act. As prices decline, banks begin issuing margin calls on real estate portfolios. Loan-to-value ratios break. Credit agreements get violated. And suddenly, institutions must either inject fresh capital or sell properties. Right now, banks are quietly tightening the screws. Credit lines are being reduced. Collateral requirements are increasing. And refinancing is becoming more expensive or unavailable. At the same time, rating agencies are stepping in. When a real estate fund gets downgraded, its borrowing costs rise. That squeezes returns even further, which triggers more selling. This creates a feedback loop. Falling prices lead to forced sales. Forced sales push prices lower. Lower prices trigger more forced sales. And unlike individual sellers, institutions sell in volume. Entire portfolios. Entire neighborhoods. This is how markets crack quietly before they break publicly. You won't see panic headlines at first. You'll see strategic portfolio adjustments, geographic optimization, capital reallocation. But make no mistake, those are exit signals. So what does all of this actually mean for you? It means the housing market is not simply cooling. It is unwinding. And unwinding markets create opportunity, but only for those who understand the timing. Institutional investors are not looking for the best price. They are looking for exits. They need liquidity. They need balance sheet relief. They need to stop the bleeding. That changes the rules completely. Instead of competing with emotional sellers, buyers will be negotiating with financial managers, algorithms, risk committees, quarterly targets. These sellers care about speed, certainty, and minimizing further losses, not maximizing upside. That's how discounts appear. Not everywhere, not all at once, but in very specific markets where institutional exposure is highest. The mistake most people make is acting too early or too blindly. This is not about rushing in. It's about watching inventory, price cuts, and institutional disclosures. When selling accelerates and demand stays weak, leverage shifts to the buyer. That window does not last forever.
Eventually, prices reset.
Capital stabilizes, and opportunity disappears. The people who benefit are not the loudest. They are the most patient. Wall Street made a massive bet on housing prices never falling. That bet is now being unwound. Quietly, structurally, and relentlessly. The question isn't whether this process continues. It's whether you understand it before everyone else does. Because markets don't reward optimism. They reward preparation.